hit its highs last year in January, and it was downhill from there. And I think you're going to see the same thing again in 2023. The highs of the year are likely to be made in January. In fact, we may have already made the highs intraday today. We'll see. But I think there's a lot of downside risk in this market. I think the only chance the market has of recovering at some point during the year would be in the aftermath of a full on Fed pivot. And I'm talking back to quantitative easing, because as long as the Fed is doing quantitative tightening, even if it stops hiking rates, if it simply leaves them alone, I don't think that's going to be enough to stop the stock market.
How will 2023 be for the stock market, and thus for the entire group of parties in the market? Well, Peter Schiff, the founder of Euro-Pacific Capital Investment, chief economist, analyst, and author, has got insights for you. Neither he nor we want to scare you about what's coming, but the facts and indicators just don't show any speck of positive growth. Should you give up all hopes of market appreciation, or is there any chance left? Peter Schiff has come with his latest takes on the 2023 market, which will linger throughout the year. He has been studying the market since the start of 2023 and has now concluded the trends that will prevail in 2023. Do you want to know what he has found? In this video, you have to get ready because we are going to reveal how 2023 will be for the markets. Let's get started. Peter Schiff started his year by focusing on the top stocks, funds, and indexes and their performance. That's why he is telling us something everyone is hiding, which is another bad year. Peter Schiff said that almost all stocks went down at the very start of 2023. This suggests that this trend will linger throughout the year. Historically, every new year often pumps new energy into the market, no matter how pessimistic investors and bearish the market is. However, 2023 is different, and for good reasons. On the very first day of 2023, Dow Jones, S&P 500, Russell 2000, and Nasdaq, all of which are renowned names in the market, went down. They just surrendered themselves to the harsh market, which opened in 2023. Peter Schiff said that this somehow sets the tone for how 2023 will be. If investors are expecting growth and a major breakthrough, then perhaps they have to give it up. The 2023 market is taking brutal revenge from even the biggest company stocks like that of Apple and Tesla. In a single day, Apple lost 3.85% of its value, reaching its 52-week lowest price. Yes, Apple is the same stock Warren Buffett bullish about, but 2023 is unforgiving. Tesla, the largest electric vehicle producer, lost about 12.5% of its value in a single day of 2023, reaching its 52-week lowest price. Here's a little reminder to like the video if you are loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. Peter Schiff said that 2023 would follow the same trend as 2022 did. In January 2022, stock prices were at their highest achievable price levels, even if investors thought they were down. Later, we saw that after January, every stock price has come down throughout 2022. Peter Schiff said that January 2023 would also see stocks at higher prices, after which the price will start to decline. That's something prudent investors need to think about. Although they might think the price is already down, it doesn't mean it's the limit beyond which the stock prices cannot go down. It's just surprising and haunting at the same time that from January 1st, 2023, we will see stock prices drop. With every passing day, the price will depreciate. However, Peter Schiff said that some CNBC experts are hoping 2023 will be a good year for investors. He said that if investors don't want to be in an illusion, they should know the reality before trusting those experts. Their theory is standing on the basis that if a year witnessed a decline, then the next year would show growth. You can judge yourself very well that it's not a rational argument at all. There is no binding that a bad year will bring a good year for the markets. Listen to what Peter Schiff said about that.
If today is any indication of how the markets are going to trade during 2023, we are in for a lot of volatility. But I think today was very telling as to how the rest of the year is likely to play out. First of all, the Dow Jones early in the morning was up better than 200 points before selling off intraday to down over 300 points before closing down just 11 points. So almost unchanged. but the other broader indexes were decisively weaker. The S&P surrendered early morning gains to close down 0.4%. Russell 2000 surrendered those gains and closed down 0.6%. And the big loser on the day, the Nasdaq, closing down 0.8% after early morning rally. And I think this pretty much is setting the tone for the way the stock market is going to play out in 2023. I think it's going to be another weak year for stocks, in particular for the stocks in the Nasdaq. In fact, take a look at some of the big names from 2022 and in fact from years past and look at what happened to those stocks today. Apple Computer, one of the most highly owned stocks in the country, the second A in FANG, was down 3.85% on the day, hitting a new 52-week low. Apple is now down by 32% since its high in January of 2022. Also, look at Tesla. It's not a FANG stock, but it was probably the first unofficial meme stock. A lot of people own Tesla. That stock was clobbered by 12.5% today, hitting a new 52-week low. It's now down 73% from its record high set in January of 2022. The market hit its highs last year in January, and it was downhill from there. And I think you're going to see the same thing again in 2023. The highs of the year are likely to be made in January. In fact, we may have already made the highs intraday today. We'll see. But I think there's a lot of downside risk in this market. I think the only chance the market has of recovering at some point during the year would be in the aftermath of a full-on Fed pivot. And I'm talking back to quantitative easing, because as long as the Fed is doing quantitative tightening, even if it stops hiking rates, if it simply leaves them alone, I don't think that's going to be enough to stop the stock market from falling. In fact, if you listen to all the coverage on CNBC this morning, which I did, as the market opened for trading in a brand new year, most of the people were saying that this was likely to be a up year. And why? Because last year was a big down year. In fact, it was one of the worst years ever. I'll get into that in a moment. But because the market was so weak in 2022, historically, when you have a down year, it's followed by an up year. So everybody just assumes that history is going to repeat, and they have absolutely no conception of why the situation is very different now than it was following prior.
But why won't 2022 be followed by a growing 2023? Well, as Peter Schiff said, historically, a declining year for the market is followed by a good year for global markets. However, if we compare the stock prices with their earnings, 2022 wasn't that bad for the stock market. If next year is to be a growth year, the stock prices have to go down. In other words, they should be undervalued, meaning their prices are lower than what they are worth. But in 2022, the stocks were not undervalued. Yes, their prices dropped dramatically, but that wasn't the worst decline. There are counter-arguments that S&P came to its lowest price since 2008 but still didn't become cheap. Peter Schiff said that S&P, even if it lost 20% of its value, it's still trading at a price equal to 20 times its earnings. That's obviously not cheap, and this won't trigger price growth in 2023. Peter Schiff said that earlier, the time can be profitable for stocks if they are below 10 times their earnings. That's when we say the stocks are undervalued. But when prices exceed 20 times their earnings, the stocks are called overvalued. In other words, their prices are determined to decline. That's a technical point. Every new year we'll try to bring the prices back to balanced levels. If prices are down, they would be hiked. But if prices are up, they would be brought down at a moderate level. Now, what will 2023 bring for stocks? Well, you know the answer. Since stocks are overvalued even now, their prices will decrease. 2023 will do everything to chop down the prices, which has already started. In the past few years, stock prices multiplied because of lower interest rates and Fed printing more money. In other words, we saw inflation in the stock market as well. Now, if someone entered the market in 2021 or 2022, They bought stocks at elevated prices. But as the free market suggests, the prices have to go down, and those investors would lose the most. But something else adds fuel to the fire. Earlier, the interest rates were low, and companies didn't have to spend more on paying higher interest. That's why earnings were high. But now interest rates have increased. Companies spend most of their earnings on them. In turn, this decreases earnings, furthering the gap between the stock prices and earnings. In other words, the stocks will appear more expensive than the earnings they bring for investors. Thus, 2023 has to chop it down, bringing the stock prices further down. That's why investors should be ready to witness the worst declines in the stock market in history now. Listen to what Peter Schiff said about that.
The stock market was down big in 2022. In fact, the S&P had its biggest annual decline since 2008. But it's not cheap. If you look at the PE of the S&P, even after a near 20% decline in 2022, it's still trading at around 20 times earnings. That's not cheap. In fact, that is expensive for stocks. If you look historically at stock market valuations before the 2000 stock market bubble, before Alan Greenspan was there artificially suppressing interest rates and blowing bubble after bubble, with each successive Fed chairman adding more pages to the same playbook, the average PE on stocks was maybe about 15 or 16 times earnings. When stocks went below 10 times earnings, that's when they were cheap. When they rose above 20 times earnings, which they did occasionally, they were expensive. That's where we are now. Now, yes, we did maintain high PEs with 0% interest rates and quantitative easing. But if you're looking at that in the rearview mirror, with the Fed hiking rates and fighting inflation, we should go back to a normal PE. We shouldn't be staying at these absurdly high valuations that were a function of monetary policy that, at least for now, no longer exists. But what's even more important than the historic PE is the fact that the E, earnings, is inflated and is going to come down. U.S. companies are not going to be able to maintain current earnings because those earnings were manufactured in an era of artificially low interest rates. Well, the ability of corporations to manufacture those earnings is gone. And in fact, as corporate debt matures and has to be rolled over at higher and higher rates, that's going to diminish corporate earnings because the interest expense is going to go up. And because so many companies are spending so much money on interest for money they borrowed in the past, they have less money to spend now. And so that also diminishes corporate earnings because they can't spend money buying the goods and services of other corporations. And consumers are going to be in the same bind. A lot of individual consumers of corporate goods and services are going to be spending a lot more interest on their own debts or paying the higher price for food, energy, insurance, healthcare, taxes. There's not going to be money left over for discretionary spending, which makes up the lion's share of corporate earnings. And so not only are stocks not cheap despite this big drop, but the earnings are about to fall through the floor, meaning stocks are even more expensive than they appear. So if we had a big down year, and as a result of a big down year, stocks were fairly valued or they were cheap, well, then maybe we'd have a rebound in the following year. But if stocks remain expensive despite a big decline, well, forget about what happened historically. I think it's far more likely that expensive stocks will continue to fall rather than rise, especially when you look at the bigger picture, which is interest rates have just risen sharply and are likely to keep rising. We have a huge inflation problem that we didn't have in other years where we had the big drop and then we had a recovery. The Fed is way behind the curve fighting an inflation problem that is going to get bigger. And it's not just the stock market that's having problems. It's the bond market. In fact, the S&P 500 had the seventh worst year ever. The total return was minus 18.1% when you include the dividends. But the bond market had the worst year ever. 10-year treasuries dropped 16%. There's never been a year where treasury bonds have fallen by 16%. And in fact, If you look at the return on the 60/40 portfolio, it was down 16.9% on the year. That is the third worst year ever for the 60/40 portfolio. And in fact, the only 2 years where investors in a 60/40 portfolio did worse than they did in 2022 was 1931 and 1937. Now, what those 2 years have in common is they fell during the Great Depression. So outside of the Great Depression, we've never had a year where investors have done so poorly on stocks and bonds.
What do you think about how 2023 will unfold itself? Will it be the year of growth, or will we see the same continuous decline prevailing in 2023? Peter Schiff said that 2023 started exactly from where we left off in 2022. And what were we doing in 2022? Well, we were getting ourselves into the depths of crisis. Comment right below in the comment section. Do you agree with Peter Schiff that 2023 will be worse than 2022? Do you want to watch more videos like this one? If yes, please like and share the video, and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.